Good afternoon. My name is Niall. I'm here to talk to you about the relationship between corporations and inflation in light of the post-pandemic inflation crisis. I'm going to start by giving you a quick run-through of the inflation crisis, then explain the theory of sellers inflation, from there show how my research advances this theory, and finish with a discussion about the significance of sellers inflation and propose some policies which would mitigate it if it should happen in the future. Grand. So inflation is broadly understood to be a sustained rise in price levels across a reasonably wide swathe of the economy, creating a corresponding decrease in real purchasing power. However, as the old lament goes, if you ask two economists a question, you get three different answers. So with regards to the inflation crisis, there was two different schools of thought regarding its main drivers. So on one hand, you had Team Persistent. They essentially said it was to do with government stimulus during the pandemic, so think furlough schemes, things like that, and that injected too much money into the economy, driving up aggregate demand. So they mostly advocated to raise interest rates, suck money out of the economy, drive down aggregate demand, and that was ultimately pursued by central banks. However, there was a lot of disagreement. Team Transitory, they said it was more to do with the fact that the whole global economy got turned upside down and took a little bit of time to reboot again, particularly because our supply chains are very intricate but fragile. They ultimately, and secondly, Russia's invasion of Ukraine pushing up wholesale prices of oil, fertilizers, food, stuff like that. They argued that efforts should have gone on helping fix supply chains and ultimately markets would self-correct. However, I'm going to skip that actually. However, as this debate was going on, corporate profits went sky high, like the highest on record since the 1950s. For both high inflation and high corporate profits to happen simultaneously is a bit suspicious. So some theorists, for example, with regards to sellers inflation, argued that there was a direct link between record profits and rates of high inflation. So causation, not just correlation. They argued that much of the inflation was neither a question of supply nor demand, but rather corporate pricing power. Grand. So the theory stipulates that powerful firms in concentrated markets were able to leverage this initial inflation surge by using it as a smokescreen to increase prices beyond the increased costs. This can be achieved because firms who dominate large proportions of markets have very few competitors and thus are not as compelled to lower prices as firms who operate in competitive markets. So a little bit of definitions. A concentrated market is just a market where only a few firms can dominate, leading to a lack of competition. A major increase in market concentration has been observed throughout advanced economies since the 1980s neoliberal pivot. Think things like privatization, deregulation, allowing firms to grow larger and larger and expand economic power. Markets which at one time had numerous firms competing now only have a handful, so think airlines, big tech, banking, pharmaceuticals, supermarkets and retail, stuff like that. Anyway, so what they did after the initial inflation surge, powerful firms were able to tacitly collude to raise prices in tandem. What that means is they didn't necessarily get on the phone to each other to say we're going to raise prices, because that would be like really illegal. They just sort of follow each other's price hikes to maintain high profits. So they implicitly understand that maintaining high prices benefits all of them. It's a sort of like wink, wink, nudge, nudge. Now's the time to like raise prices. This can't be done in competitive markets with heaps of firms. Furthermore, consumers are expecting price hikes because they know inflation is in the air, but they have sort of imperfect information regarding how much they should expect in regards to costs. So these businesses take advantage of this and try and capitalize on that fact. This represents market failure, as prices are meant to be determined by supply and demand dynamics. This is more of a matter of and if markets were competitive, increased prices would have been a lot more in line with costs, as firms are meant to compete for customers by lowering prices. That's capitalism, essentially. Therefore, this is a form of extraction and market manipulation. So this was just kind of part of my research, to be honest, and this aimed at substantiating sellers' inflation and showing it occurred throughout advanced economies. So I took a mixed method approach, and I used quantitative and qualitative data taken from studies and reports carried out by a range of different groups, so trade unions, central banks, economic think tanks, other policy institutes, all kinds of stuff. And they analysed corporate profits over this period of time. Sorry. And therefore, special attention was given to evidence of higher markups, which is the percentage added to cost to create a selling price, and higher profit margins. That's just the percentage of revenue that remains as profit after expenses are deducted, and the correlation with large firms operating in concentrated markets, as these are all indicative of sellers' inflation's impact on overall inflation rates. So my results, it was kind of conclusive in a way. So in the USA, there was a historic rise in markup growth. It went from about 56% to 72% in 2021. It's unprecedented. The jump like that's never happened before. And then research found that the estimates being sales inflation, corporate profiteering, use them interchangeably, contributed to about 40–50% of overall inflation in the USA. UK was even worse. So there was a 30% average increase in profit margins across firms. That was highly concentrated in the most profitable large firms in the UK economy, who all operate in concentrated markets. Particularly energy generation and supermarkets made a killing. And even by 2024, the Bank of England really grudgingly admitted that increased profit margins contributed about 75% of inflation in the UK by the end of 2022. Eurozone, same thing. As you can see, IMF concluded it contributed about half of Eurozone inflation up until about 2022. You've got Christine Lagarde, you might have heard of, President of the European Central Bank. She said, sectors have taken advantage to push costs through entirely without squeezing on margins, and for some of them to push prices higher than the cost push. Sellers inflation. So, this is quite interesting. A lot of these studies focused on earnings calls. So an earnings call is just where sort of top executives in firms, they get on the horn to their shareholders and explain just how well the company's doing, that sort of thing, what kind of strategies they're employing. They legally have to tell the truth on these earnings calls. And these researchers found across the board that they were essentially boasting about using the inflation crisis as a strategy to, bring in higher prices and stuff above their rising costs. So, what this all means. Basically, the short of it is this did create a massive wealth transfer in society for the vast majority of people, us, I take it. This meant just a higher cost of living because wages did not keep up with rising prices anywhere, especially in the UK. Lost my place. So necessities such as food, housing and energy saw some of the biggest price hikes, and there was just a general increase in poverty rates and just a historic fall in living standards. However, on the other side of the coin, if you were a shareholder, particularly if you had lots of them, you did very, very well out of all this. So there was record high profits, which were converted into record high share buybacks and dividends for wealthy shareholders. Effectively, the inflation crisis and cost of living crisis was pretty awful for the vast majority of people, particularly those in the lower 50–60% of the income scale, but incredibly lucrative for the wealthiest strata of society. About 50% of shares are owned by 1% at the top of the income scale. This effectively substantially exacerbated and increased economic inequality in advanced economies, which has been rising ever since the neoliberal pivot since the 1980s. Economic inequality matters a great deal. Namely, it erodes the social contract and is a major catalyst for political instability and support for far-right parties, which we've been seeing a lot of since the end of the inflation crisis. In conclusion, are we there? Yeah, grand. Despite overwhelming evidence of sellers' inflation, there's been remarkably little government scrutinization and public discourse appropriately acknowledging this phenomenon, and particularly in the UK. With more inflationary shocks to the global economy likely, in the years ahead is urgent to be addressed, so those shocks do not need to be worse. Is that for me? That's nothing to do with me. Oh, that's great then. Oh, right, and anyway, there are a bunch of things you can do. Spain actually was an outlier. Spain did a lot of these things to try and protect citizens during the cost of living crisis and stuff. Try to redistribute some of these profits more effectively. You've got a lot of temporary price controls to protect citizens at the time. But you also just need more forceful legislation to break up concentrated markets so this doesn't happen in the first place. Strengthening labour bargaining power would also be helpful. And yeah, that's pretty much all I've got for you, actually. So I'll call it there.